The story of Credit Suisse begins in earnest 1856 with the vision of building a nation. But it ends in 2023 with a government-brokered rescue to prevent a global financial collapse.
Ja, warum hat man jetzt nicht einfach die Gruppe Konkurs gehen lassen und man hat das Schweiz-Geschäft weitergeführt?
What happened during those 167 years of the bank's lifetime? We'll find out about the cultural change that led Credit Suisse down its dark path, and how this institution that once represented Swiss caution found itself unable to navigate the very system it had ultimately created for itself.
Welcome to the Discovery Clock series.
In the early 19th century, Switzerland was still a loose and fragile political construct. Following the Congress of Vienna in 1815, the country existed as a confederation of 22 largely sovereign cantons, bound together more by mutual defence than by economic unity. There was no single currency, no standardised postal system, and internal customs barriers made the movement of goods slow, costly, and inefficient. At a time when the Industrial Revolution was reshaping economies in Great Britain and France through coal, iron, and mechanised production, Switzerland faced structural disadvantages. The country possessed few natural resources, and its mountainous terrain posed formidable challenges to large-scale infrastructure development. Yet, these constraints would also help in shaping a distinct economic model for Switzerland. The Swiss industry was developing, for the most part, in a decentralised manner, particularly in textiles and watchmaking, relying on networks of small-scale, highly specialised producers. This system favoured precision, adaptability, and export-oriented production, rather than the mass industrialisation of that era. A shift did come in 1848 with the new federal constitution. Switzerland effectively transitioned from a confederation into a federal state on 3 levels: federal, cantonal, and communal, with the cantons retaining some of their sovereignty in the process, thus creating a unified economic area with a semi-centralised federal authority over trade, currency, and infrastructure. However, political unification did not immediately resolve the country's financial limitations. Switzerland still lacked the institutional capacity to mobilise the large volumes of capital required to develop its modern infrastructure, most notably its railway system. But this problem would later be solved by one of the most influential figures in Swiss history, Alfred Escher. Born in 1819 into a prominent Zurich family, Escher rose rapidly through the political ranks, becoming a member of the cantonal parliament in Zurich, and in 1848 one of the leading figures in the newly established National Council, or the People's Parliament Chamber, which he would later preside 4 times. Escher was a leading representative of the 19th century liberalism, advocating for economic freedom, combined with strong institutions in education and infrastructure. He understood that Switzerland was at risk of being economically marginalised by its neighbouring countries. European powers were developing railway networks that would bypass the Alpine region entirely, diverting important trade flows away from Swiss territory. To address this, Escher devised a strategic long-term plan. For instance, in 1855, he played a central role in founding the Federal Polytechnic Institute, today's Eidgenössische Technische Hochschule Zürich, or ETH Zurich, a national school created to train engineers and scientists for Switzerland's industrial takeoff, from railway construction and bridge building to hydraulics, mechanics, and architecture. At the same time, Escher championed the Railway Act of 1852, which placed railway construction primarily in the hands of private companies rather than the federal state. While this approach was believed to accelerate the railway development, it highlighted an urgent need for reliable, large-scale infrastructure financing within Switzerland. Thus, in 1853, Escher co-founded the Schweizerische Nordostbahn, or Northeastern Railway, which became the country's most important private railway company. However, securing capital to expand the railway proved difficult. Foreign banks, particularly from France and Germany, were willing to invest, but often at high interest cost, and with conditions that implied political influence. For Escher, this posed a direct threat to Swiss sovereignty. And to resolve this matter once and for all, he would found in 1856 the Schweizerische Kreditanstalt, or SKA, known today as Credit Suisse. Conceived not as a retail bank, but as a financial institution dedicated to industrial investment, SKA mobilised domestic and international capital to fund large-scale infrastructure projects in Switzerland. However, things for the bank would not turn out to be smooth sail at the beginning. Indeed, the financing of private railroads was, at the time, an intensely volatile and speculative business market, which would put the bank in a very risky and unstable position. The bank would go through a period of trial and error, compounded by a management team with limited banking experience. But things would take a turn for the worst a year later with the Panic of 1857. The Panic of 1857 was a financial crisis that began in the United States and then spread internationally. It was triggered by a mix of problems. The collapse of the Ohio Life Insurance and Trust Company in August 1857, falling confidence in banks and credit markets, and a severe downturn in railroad-related speculation. Railways were one of the biggest growth sectors of the 1850s, so when railroad profits and asset values came under pressure, the damage quickly spread through the wider financial system. And because the world economy during that time was already far more interconnected than in previous decades, through railways, steamships, trade, international capital flows, but more importantly, with the coming of a new form of telecommunication that made news travel at a faster speed, the telegram, the shock moved quickly through markets from the US to Britain and other European financial centres, with some historians calling it the first global economic crisis. Caught up in the railroad speculation and tightening credit, SKA suffered substantial losses, and by 1859 was forced to write down half of its share capital. Yet, while losses repeatedly threatened its existence, the bank's viability on the long term remained strong. SKA had the powerful backing of Zurich's political and industrial elite. Supported by the city's rise as a business metropolis, the bank quickly became the nation's largest commercial bank. Having navigated this difficult period, SKA went on to pursue its mission on a grand scale. Its most significant contribution was in its role of financing the Gotthard Railway and its 16-kilometre summit tunnel, completed in 1882, and becoming one of the most ambitious engineering projects of the century and a critical north-south European transit route. It was described by engineer Adolphe Gautier as the greatest work hitherto attempted by man. As the 20th century began, the bank emancipated itself from the business that had facilitated its initial success. With the railways largely nationalised in Switzerland by 1902, SKA's focus shifted to commercial loans and emerging sectors such as the electricity industry. But the pivotal change that transformed it into a global institution came during the interwar period. In the aftermath of the First World War, political unrest, hyperinflation, and high taxes drove substantial capital from neighbouring countries towards the stability of Switzerland. As a neutral and monetarily sound nation, it slowly became a safe haven for foreign assets. The more uncertain the world became, the better business was for Creditanstalt. This dynamic turned SKA into an internationally respected institution and helped establish Zurich as a key financial centre alongside New York, London and Amsterdam. For the first time, the assets of major banks such as SKA exceeded those of the state-backed cantonal banks. After the Second World War, Switzerland's banking sector benefited once more from its image as a safe haven for foreign capital, whilst banking secrecy, formalised in the Swiss Banking Act of 1934, became one of its most powerful competitive advantages. This marked the emergence of a distinct Swiss financial model, whose financial reputation was increasingly tied to stability, discretion, and political neutrality. Banking, political leadership, and industrial development became closely intertwined, forming a system oriented toward long-term stability and the needs of the real economy. This model emphasized prudence, credibility, and a national interest over short-term speculation. For several decades, SKA's internal culture would remain cautious and centralized, shaped by a small circle of senior executives in Zurich who valued prudence, confidentiality, and continuity. But in 1977, that reputation would suffer a major blow in what would become known as the Chiasso Affair. The Chiasso Affair was one of the biggest banking scandals at the time, and it broke in 1977 at Credit Suisse's Chiasso branch near the Italian border in the canton of Ticino. It began when branch managers, including Ernst Kurmeier, had used a Liechtenstein shell company called Texan to channel Italian funds into hidden investments for years outside of normal bank oversight. When those investments turned bad after the 1973 oil shock and the broader downturn in Europe, the structure collapsed and exposed massive losses, roughly 2.2 billion Swiss francs by the bank's own accounting, with early estimates ranging much lower. What made the affair so serious was not only the size of the losses, but the fact that it exposed deep weaknesses in control, auditing, and internal supervision inside a bank that was supposed to embody Swiss caution. The scandal became public in spring 1977. Arrests followed suit, and the bank's leadership was forced into a major clean-up and reorganisation. The Swiss National Bank even offered a 3 billion Swiss francs bridge loan to prevent a widespread panic, but Credit Suisse did not end up taking it. The bank also had to write down large losses and absorb a hit to its reputation, while the case contributed to tougher Swiss banking standards. Indeed, Swiss banks adopted the first due diligence agreement in 1977, designed to strengthen client identification and combat misuse of the banking system. For SKA, the scandal marked a turning point. With an ever so slightly damaged reputation, this accelerated internal changes within the bank and helped push the institution towards a more international strategy and subsequently a more aggressive one that would come to undermine all that the bank had achieved until now. To better understand how a conservative Swiss bank ended up owning one of the most aggressive firms on Wall Street, and how that very firm would ultimately become the architect of its collapse, we have to go back to 1933, right into the wreckage of the Great Depression.
Conveniently at any time. I can assure you, my friends, that it is safer to keep your money in a reopened bank than it is to keep it under the mattress.
It was panic.
16.5 million shares of stock sold in a single day. Sold hopelessly, desperate, at any price.
In 1933, in the wreckage of the Great Depression, Congress passed the Glass-Steagall Act. The law was a direct response to the 1929 crash, and its logic was simple. Commercial banks, the institutions that held ordinary Americans' deposits, had been speculating in the securities markets with that very money. When the markets collapsed, the banks collapsed with them, and millions of people lost their savings. The Glass-Steagall Act was designed to ensure that could never happen again. It drew a hard line between commercial banking on one side and investment banking on the other. No institution could do both. And so, on the 27th of June 1932, in anticipation of the law's passage, the investment banking arm of the First National Bank of Boston was separated from its parent company and established as an independent entity, the First Boston Corporation. The main commercial bank continued on its own path, eventually becoming part of what is today Bank of America. But First Boston would set out to build something entirely different. Indeed, in its early years, First Boston would absorb talent and businesses from other institutions forced through the same separation. But this would push the firm towards the higher margin, higher risk business of advisory work, underwriting, and eventually towards mergers and acquisitions, the very activities that would define it at its peak. By 1970, First Boston was considered part of Wall Street's bulge bracket, the small group of elite firms that dominated the most significant transactions, alongside Morgan Stanley, Dillon Read, and Kuhn Loeb. That same year, the firm would raise more than $10 billion in new capital annually for its underwriting clients. That forced appetite for risk perfectly positioned them for the 1980s. For decades, First Boston had simply been waiting for the right environment, and when Ronald Reagan took office, that environment had finally arrived.
With tax reform, America will have the lowest marginal rates and the most modern tax code in the industrialized world, one that encourages risk-taking, innovation, and that old American spirit of enterprise.
As the 1970s gave way to the 1980s, the global financial landscape was in the middle of a fundamental shift. Deregulation was sweeping through markets in London and New York. The old stately pace of institutional banking was giving way to something faster, louder, and far more competitive. Investment banking was no longer a gentleman's profession. It was becoming an industry, craving for something bigger. At the centre of it all was Washington. When Ronald Reagan took office on the 20th of January 1981, he came in with a clear philosophy to get the government out of the way and to let the markets do the rest. He began by cutting the top marginal income tax rate from 70% to 28%. He then adopted the Gans-Saint-Germain Act of 1982, deregulating the savings and loan sector, and the Tax Reform Act of 1986, subsequently reshaping corporate borrowing incentives in ways that poured fuel on the leveraged buyout boom.
The government's view of the economy could be summed up in a few short phrases. If it moves, tax it. If it keeps moving, regulate it. And if it stops moving, subsidize it.
Wall Street discovered that you could buy a company not just with the cash that you had, but with the debt you could issue. Michael Milken at Drexel Burnham Lambert turned high-yield junk bonds into a $200 billion market by 1986. The hostile takeover, the leverage buyout, and the corporate raider were no longer just fringe activities. They were becoming the defining economic events of that era. In 1980, the total US merger and acquisition activity stood at around $44 billion, or $177 and $83 billion in 2026. By 1988, it had climbed to $246 billion, or $692.50 billion. American culture reflected this need for a bigger, better, and more extravaganza opulence, all without apology. And during that period, Oliver Stone's Wall Street film would arrive in 1987, giving the world Gordon Gekko as a cautionary figure of greed.
Ladies and gentlemen, that greed, for lack of a better word, is good. Greed is right. Greed works. Greed clarifies, cuts through, and captures the essence of the evolutionary spirit. Greed in all of its forms. Greed for life, for money, for love, knowledge, has marked the upward surge of mankind, and greed, you mark my words, will not only save Teldar paper, but that other malfunctioning corporation called the USA. Thank you very much.
Stone naturally meant it as a warning, but a significant portion of Wall Street took Gekko's greed to heart, and as the foundation of a new business philosophy. By the 1980s, First Boston's Merge and Acquisitions Department had become the engine of the firm. A 1985 Fortune magazine article called it the archetypal deal factory. A year in which it completed $60 billion in merger transactions, placing it second only to Goldman Sachs. The Texaco hostile takeover of Getty Oil, the leveraged buyout of Federated Department Stores, which alone generated $200 million in fees. First Boston was everywhere that mattered, and the men responsible for this new wave of success were Bruce Wasserstein and Joseph Perella. Wasserstein, known in the industry as Bid-em-up Bruce, for his tendency to push clients toward the most aggressive valuations the logic would support, and Perella, his more methodical counterpart, had together built First Boston's merge and acquisitions practice into a force that clients came specifically to them because they wanted to win. We were the hired guns. When a company came to us, they wanted to know one thing: how do we win? And we told them. But by 1987, the internal politics of the firm had soured. Wasserstein wanted the management committee to redirect resources toward his merge and acquisitions unit from bond trading, but they refused. And so, in February 1988, he and Perella walked out entirely, taking their reputations and their client relationships with them to found Wasserstein Perella and Company. Their departure left the firm in a genuinely difficult position. The franchise they had built was, in large part, walking out the door with its architects. But what happened next would make things considerably worse for First Boston. First Boston's leadership, under Chief Executive Peter Buchanan, had been leaning heavily into the leveraged buyout business. So, in 1988, the firm provided bridge financing for the buyout of the Ohio Mattress Company, the manufacturer behind the Sealy brand. First, Boston committed $457 million, a figure that represented roughly 40% of the firm's entire equity capital. The logic was standard for the era, and it meant holding the bridge loan briefly, selling it into the junk bond market, and subsequently collecting the fees at the end. The whole cycle was supposed to only take a matter of months. But this time round, it never happened.
After last Friday's record 108-point loss, analysts had expected a rally. Instead,
it's a panic. Everyone's in panic. Everybody, we're trying to find a bottom. We're trying to, I'm as a floor broker, I see stocks trading 10 points below where they traded Thursday, and I'm saying this has to be the bottom. And then they trade 5 points lower than that.
By noon, the market was down about 150 points. The tape delayed by more than an hour, but it only got worse.
And so, in February 1990, the cards on Wall Street began to topple one by one. Drexel Burnham Lambert, the firm that had thrown into motion the junk bonds euphoria, ended up filing for bankruptcy. The junk bond market, already weakening through 1989, effectively froze overnight. No one was willing to buy anything. First Boston was thus left holding $457 million in loans it could not sell, on a deal it could not exit, and in a market that no longer existed. The position greatly threatened the firm's solvency. On Wall Street, their transaction had acquired a nickname: the Burning Bed. Peter Buchanan was left with no good options. He turned to the one partner, at the time, with the resources and the motivation to help. In October 1988, that partner would be Rainer Emil Gut, the chairman of Credit Suisse's board of directors. Rainer Gut and Buchanan had already formalised a deeper relationship. Indeed, in 1978, Credit Suisse already had a 44.5% stake in a newly private joint venture, with First Boston's management retaining 25%. But to understand why a notoriously conservative Swiss bank would tie its fate to a collapsing Wall Street firm, we have to understand the man making the decision. Who was Rainer E. Gut? Rainer Emil Gut was not your typical Swiss banker. Born in 1932 in Bar, a small town near Zug, his father was a bank director. Finance was the family business, but his trajectory would look nothing like what his strict traditional upbringing suggested. In 1956, while living in Zurich, Gut met Josephine Lorenz, an American former photo model from Detroit. They would marry a year later in his hometown of Bar, and that American connection would eventually become one of the defining moments in his life. Indeed, shortly after getting married, his career would take him across the Atlantic. Union Bank of Switzerland, or the bank we now know as UBS, had sent him to work in New York. Gut served as a crucial New York liaison for the top executives shuttling back and forth from Zurich. He was young, effective, and deeply ambitious. But when the time came for a major promotion, the rigid Swiss institution passed him over, and this would end up being a turning point in Gut's life. Feeling sidelined by the Swiss bank, Gut would later join, in 1968, the elite American investment bank, Lazare Frères, as a general partner. And for the next 3 years, Gut would be immersed into the sharp, aggressive, and highly lucrative world of Wall Street deal-making. He would live through its rhythms, its culture, and its incentives. And his unique dual perspective did not go unnoticed. Indeed, in 1971, SKA, or Credit Suisse, would poach him from Lazare Frères, asking him to run their own New York-based investment banking arm, known as Swiss American Corporation. Gut had managed to become the rare executive who understood simultaneously the cautious halls of Zurich just as well as the cutthroat trading floors of Manhattan. What Gut saw in America was a financial industry that had found a fundamentally different way of generating wealth. Not through the patient accumulation of assets under management, nor the careful stewardship of inherited fortunes, but through merger advisory mandates, equity underwriting, leveraged buyout, and fees that arrived in weeks rather than years. It was aggressive, it was competitive, and it was producing returns that Swiss banking could not match. Gut eventually returned to Zurich, joining SKA's executive board in 1973, becoming its spokesman by 1977 and chairman in 1982. He had observed the Chiasso scandal and believed that a bank dependent on a single model, that is, Swiss discretion, steadiness and secrecy, was more fragile than it appeared. In Gut's mind, America's cultural finance was the answer. And he was convinced that Credit Suisse needed to become part of it and adapt to it. Traditional Swiss banking was stable, but it was not generating the returns that Wall Street was producing. Gut's goal was to build a genuine global Swiss investment bank capable of competing with Goldman Sachs and Morgan Stanley. But in order to do that, he needed an American platform with an established deal flow, seasoned talent, and a brand that Americans already trusted. By 1988, the opportunity he had been waiting for arrived. First Boston's catastrophic $457 million investment in the Ohio Mattress Company had pushed the firm to the brink of collapse. Because of this debacle, Credit Suisse's joint arrangement with First Boston was becoming too difficult to hold on to. And so, in 1990, Credit Suisse was subsequently forced to inject an additional $300 million into First Boston. It therefore ended up taking a controlling stake that would eventually exceed 60%. There was an uncomfortable irony embedded in this rescue that few people mentioned at the time. The safety arrangement between Credit Suisse and First Boston was arguably in violation with the Glass-Steagall Act of 1933, the very law that prohibited such fusions, and the one that had created First Boston in the first place. A commercial bank, Credit Suisse, was now the controlling owner of an investment bank. But why was such a fusion even allowed, if it was illegal? Well, to put it simply, the Federal Reserve, the US bank regulator, had quietly concluded at the time that avoiding the bankruptcy of a major Wall Street firm served the public interest better than enforcing the letter of the law. The separation that Glass-Steagall had mandated in 1933 was, in practice, dissolved. It would take until 1999 for the law to catch up with reality. That very year, President Bill Clinton would sign the Gramm-Leach-Bliley Act, a legislation that formally repealed the Glass-Steagall Act and made permanent what the First Boston rescue had already made true. Commercial banks could now own investment banks. The wall erected in the wreckage of the 1929 crash was officially gone.
It is true that the Glass-Steagall law is no longer appropriate to the economy in which we live. It worked pretty well for the industrial economy, which was highly organized, much more centralized, and much more nationalized than the one in which we operate today. But the world is very different. Now we have to figure out, well, what are still the individual and family and business equities that are still involved that need some protections? And the long and often tortured story of this law can be seen as a very stunning specific example of the general challenge that will face lawmakers of both parties, that will face liberals and conservatives, that will face all Americans as we try to make sure that the 21st century economy really works for our country and works for the people who live in it.
Credit Suisse owned the firm. The new entity would be called Credit Suisse First Boston, and it was about to discover what that truly meant. Indeed, this would mark the beginning of a long and painful fall for Credit Suisse. When the paperwork was finalized in 1990, Rainer Emil Gut finally had his prize. Credit Suisse now owned First Boston. On paper, It was supposed to be a financial masterstroke that created a new Swiss global powerhouse. But, in reality, fusing Swiss conservatism with Wall Street ambition was famously described by financial observers as mixing oil and water. You could force them into the same corporate structure, but they would never truly blend. This fundamental incompatibility sparked a bitter, decade-long civil war. In Zurich, at the bank's headquarters on Paradeplatz, banking was viewed as a multi-generational stewardship. Credit Suisse was a 134-year-old institution built on a philosophy of extreme capital preservation. The bank was managed by committees. Decisions required deep consensus. Risk was something measured over decades, and loyalty to the institution was paramount. But across the Atlantic, in Manhattan, First Boston operated on an entirely different logic. The culture was that of a mercenary enterprise. Performance was fiercely individualistic, and compensation was tied directly to the fees a banker could generate in a single quarter. The star deal-makers held client relationships that were theirs personally. Loyalty was measured exclusively in bonus payouts, not tenure. Zurich technically held the authority over the new entity, but it was New York who generated the massive advisory fees, and this dynamic quickly created a profound hostage situation within the bank. First, Boston was led by aggressive American executives like John Hennessy, and later, Alan Wheat. These were Wall Street veterans who understood exactly how much leverage they held over their Swiss bosses. Credit Suisse needed First Boston's top talent to justify the billions of dollars they had just spent on the acquisition. The Americans knew this. Whenever Swiss executives tried to enforce traditional risk limits or attempted to cap the exorbitant bonus pools, First Boston's top rainmakers deployed a simple, brutal threat. They would walk across the street to Goldman Sachs or Morgan Stanley, and they would take their billionaire corporate clients with them. Terrified of losing the very engine of their revenue, the executives in Zurich repeatedly surrendered. To satisfy the relentless demands of the New York's trading floor, Credit Suisse's leadership began prioritizing short-term return on equity above all else. And by the late 1990s, Credit Suisse's bonus pool was among the most generous on all of Wall Street. The Swiss risk-adverse mindset began to slowly disappear. The risk committees that had protected the bank for over a century were deliberately hollowed out by a decade of concessions. A tragic shift had occurred. A conservative Swiss bank had paid billions of dollars to become a hostage to its own subsidiary. The First Boston mindset was no longer just a business strategy. It had become a cultural virus, a pathogen that slowly eroded long-term integrity in exchange for immediate financial reward. And having successfully infected its Swiss parent, the American dealmakers were about to package that exact same virus and export it to the rest of corporate America. And unfortunately, this would lead another well-known company falling prey to this toxic cultured mindset. In 1996, Boeing, a company proudly run by engineers, acquired its struggling rival, McDonnell Douglas, for $13 billion in a merger orchestrated by Credit Suisse First Boston. The deal was driven by John Craig Oxman, an American First Boston deal maker who pushed a financially flawless strategy that completely ignored the human cost.
Breaking news, an Ethiopian Airlines flight has crashed shortly after takeoff from Addis Ababa, killing all 157 passengers and crew thought to be on board. The airline told state media there were people of more than 30 nationalities.
Though Boeing bought the company, it was McDonnell Douglas who effectively took over Boeing's management and work culture. Led by executive Harry Stonecipher, they deliberately dismantled Boeing's meticulous engineering soul to prioritize short-term Wall Street returns instead. The profound irony of this is that the exact same cultural virus Credit Suisse first Boston exported to Boeing was quietly eroding Credit Suisse itself from within. Credit Suisse had long been guided by Swiss executives who were inherently bound to the country's ethos of caution and long-term stability. But by the early 2000s, that heritage was abandoned. The executive suite became a revolving door for foreign executives and Wall Street veterans who lacked that inherent Swiss mindset. In 2001, the American investment banker John Mack, a man famously known on Wall Street as Mack the Knife, was brought in as co-CEO. And in 2007, the board handed the CEO position to Brady Dugan, an American equities trader who had come straight out of the first Boston machine. The multi-generational stewardship of Zurich had been officially replaced by the survival instincts of Wall Street, and almost immediately that new instinct was put to the ultimate test. Just 1 year after Dugan took the helm, the 2008 global financial crisis tore through the world economy. Directly across Paradeplatz in Zurich, Credit Suisse's fiercest rival, UBS, crumbled under its own weight of toxic American mortgage debt. UBS was forced to accept a humiliating bailout involving a $60 billion fund to absorb its toxic assets and the direct capital injection of over $5 billion just to keep its doors open. Credit Suisse, however, navigated the panic much differently. Under Brady Dugan's leadership, the bank proudly refused state aid. But they still needed money to survive. So they turned to a very specific, pre-existing relationship that they trusted: their own private banking clients. Indeed, for years, Credit Suisse's wealth management division had actively catered to Middle Eastern royalty. One of their most prominent clients was Hamad bin Jassim Al Thani. He was not only the Prime Minister of Qatar, but crucially, he was the head of the country's sovereign wealth fund, the Qatar Investment Authority. Leveraging this elite private connection, Credit Suisse scrambled to raise 10 billion Swiss francs in emergency private capital, anchored heavily by the Qatari fund. They survived the Great Crash without a taxpayer rescue. The financial press praised them. But the hidden reality of the Qatari rescue was staggering, and it revealed the true priorities of the men running the bank. Why did Credit Suisse go to Qatar instead of Bern? Because a Swiss government bailout came with heavy, non-negotiable strings attached. Taking state money meant the government would demand severe oversight. They would slash executive pay, and they would strictly cap the massive bonus pools. To the Wall Street bankers now running Credit Suisse, losing their bonuses was simply unacceptable. So they turned to Qatar. But the Middle Eastern capital did not come cheap. To avoid government interference, Credit Suisse agreed to highly predatory terms. They issued convertible notes to the Qatar Investment Authority that carried exorbitant interest rates, some exceeding 10%. Over the next decade, Credit Suisse would bleed billions of dollars in interest payments just to service that specific debt. The executives had essentially mortgaged the long-term financial health of a 150-year-old bank entirely to protect their own short-term compensation. And the psychological damage of that survival was even worse. Because they hadn't taken government bailout money, Credit Suisse felt vindicated. They developed a culture of arrogance and a fatal sense of being invincible. In the aftermath of the 2008 crisis, most major global banks spent the next decade reining in their traders, cutting risk, and reforming their corporate cultures. But Credit Suisse believed their aggressive model was bulletproof. They ignored the shifting regulatory winds. They kept their foot firmly down, actively courting the high-risk, high-yield clients that other banks had specifically blacklisted. The arrogance born in the 1980s, exported to corporate America in the 1990s, and validated by the crash of 2008, was now permanently embedded in the foundation of the Swiss bank. Credit Suisse had successfully captured Wall Street, but they had sold their soul to do it, quietly setting the stage for one of the most spectacular collapses in modern financial history.
Shares in Lehman Brothers have plummeted more than 80% in 2008 alone.
Lehman, like so many other investment banks and banks, really got, quite frankly, caught up in the housing bubble. But like every bubble, the bubble ended, and now we're seeing the downside of that bubble.
In the years following the 2008 financial crisis, the culture cultivated under Brady Dugan gave way to a series of damaging controversies. Credit Suisse found itself entangled in a succession of profound missteps. The institution suffered immense losses from the collapse of the Archegos family office. But the failures extended well beyond risk management. The bank faced severe international fines for its involvement in the Mozambique tuna bonds scandal, where employees were found to have facilitated illicit loans. The internal atmosphere had grown so fractured that by 2019, the bank's chief executive, Tidjane Thiam, was implicated in an extraordinary corporate espionage scandal, having hired private investigators to follow his own executives through the streets of Zurich. Step by step, the bank was eroding its most vital asset, public trust. By the spring of 2023, the institution's foundation was deeply compromised. The final turning point, however, arrived from across the Atlantic.
The ripple effects from the collapse of Silicon Valley Bank on Friday are being felt across the world. The US government's now said it will ensure all SVB account holders will be able to retrieve any funds they have when they start their day today. A statement by the US Treasury and Federal Reserve said the plan will ensure the resilience of the broader US banking system. In the meantime,
in early March of that year, the sudden failure of Silicon Valley Bank in the United States sent a shockwave of uncertainty through the global financial system. It was a stark reminder of how swiftly a modern bank run could unfold. Spooked investors immediately began reassessing other vulnerable institutions. With its reputation already weakened due to years of scandals and losses, Credit Suisse was uniquely exposed. The market's anxiety reached a breaking point just days later, when the chairman of Credit Suisse's largest shareholder, Saudi National Bank, stated that no additional financial support would be provided. That single statement triggered a profound crisis of trust. A modern digital exodus began at an unprecedented pace. Wealthy clients, fearful for their life savings, quietly transferred their assets to rival institutions. At the height of the crisis, Credit Suisse saw deposit outflows exceeding 10 billion Swiss francs in a single day. the Swiss National Bank attempted to stabilise the situation, extending a 50 billion franc emergency liquidity line to project resilience. But the gesture was not enough. The withdrawal of client funds continued unabated. By Friday evening, the reality was inescapable. Credit Suisse could not survive the weekend. An uncontrolled collapse of a globally systemic bank threatened to severely disrupt the international economy. In a functioning system, a failing institution of this size would be managed by its national regulator. But for years, the Swiss Financial Market Supervisory Authority, known as the FINMA, had struggled to effectively govern Credit Suisse. Operating as a largely ineffectual watchdog, the FINMA had watched the bank drift from crisis to crisis, issuing formal reprimands, but failing to correct its trajectory. Now, with the bank in free fall, the regulatory framework had entirely exhausted its options. The crisis had outgrown the regulators. And with the FINMA unable to act, the immense burden of preventing a worldwide financial meltdown shifted into the political arena. It fell squarely on the shoulders of Finance Minister Karin Keller-Sutter. With global markets set to open on Monday morning, she had less than 48 hours to engineer a rescue. While foreign financial institutions expressed interest in acquiring the troubled bank, Keller-Sutter and the Federal Council insisted on a domestic solution. They needed a buyer with a balance sheet large enough to absorb Credit Suisse, and that buyer would be none other than Credit Suisse's fiercest rival in Switzerland, UBS. Yet, as Keller-Sutter guided these delicate, high-stakes negotiations behind closed doors, her fragile timeline was disrupted by a significant media leak. Indeed, on Friday afternoon, the Financial Times published an exclusive report revealing the emergency talks. Under Swiss law, domestic journalists face severe penalties for publishing leaked banking data. To circumvent this strict legislation, an insider from Credit Suisse had discreetly passed the information to the British-based publication. The sudden disclosure caught the Finance Minister and the Federal Council entirely off guard. Stripped of the ability to quietly manage the narrative, the Swiss government was forced to act with desperate speed. To finalise the acquisition before Asian markets opened on Sunday evening, the government had to bypass standard corporate law, which ordinarily requires a lengthy consultation period and a shareholder vote. However, Keller-Sutter did not have the luxury of time. Invoking an emergency executive privilege known as note theft, the government unilaterally suspended the democratic voting rights of the shareholders. The established legal framework was quietly set aside to avert a global panic. The terms of the acquisition were sobering. UBS agreed to purchase Credit Suisse for 3 billion Swiss francs, a fraction of its historical value. To facilitate the deal, the Swiss government provided a 9 billion franc guarantee to absorb potential losses, supported by a massive liquidity line from the Swiss Central Bank. But to finalise the agreement, the authorities had to make one unprecedented decision. They targeted a specific class of debt known as Additional Tier 1 or AT1 bonds. In the traditional hierarchy of a financial bankruptcy, shareholders are meant to bear the ultimate losses before bondholders are affected. The Swiss authorities, however, inverted this standard. They ordered the complete erasure of 16 billion Swiss francs worth of AT1 bonds. The bondholders lost everything in an instant, while shareholders retained a small portion of their value. It was a severe compromise of Swiss legal predictability. But the government stood firm, viewing the bondholders as an unavoidable casualty to secure the broader economy. On the evening of Sunday, 19th of March, a sombre press conference took place in the Federal Palace in Bern. Finance Minister Karen Keller-Zutter sat alongside the executives of UBS and Credit Suisse. The room was heavy with the gravity of the occasion. There was no sense of triumph, only a profound, quiet recognition of a national loss.
Le Conseil fédéral s'est réuni aujourd'hui en séance extraordinaire pour parler de la situation du Credit Suisse. Ces tout derniers jours, plusieurs places financières ont subi des turbulences importantes. Ces turbulences ont déstabilisé les banques les plus fragiles, et ça a été le cas pour le Credit Suisse, et ce, malgré une bonne capitalisation, le Credit Suisse a perdu la confiance des marchés.
Pour moi, c'est inimaginable qu'un truc comme ça se passe.
Je suis sans voix et en colère.
Oui, c'est triste. Beaucoup ont travaillé toute leur vie ici.
C'est vraiment une tragédie pour beaucoup de personnes, pour beaucoup de familles.
Pour avoir une réaction ce matin. Madame, est-ce qu'on peut vous poser une question?
On n'a pas le droit de répondre à la presse, désolé.
Vous êtes dur ce matin?
Ouais.
Bonjour monsieur, qu'est-ce que vous aimeriez dire à vos dirigeants?
With a few signatures, Credit Suisse ceased to exist as an independent entity.
Es ist ein historischer, trauriger und sehr herausfordernder Tag für die Credit Suisse, für die Schweiz und die globalen Finanzmärkte.
Credit Suisse now belonged to UBS. For the Swiss public, the announcement brought shock and a deep sense of betrayal.
Je suis profondément déçu des managers qui se sont enrichis sans scrupule, comme si c'était un self-service. Et pour cette mauvaise gestion, ils ont encaissé des millions.
Credit Suisse had been woven into the daily fabric of the country. In the halls of government, the reaction was equally intense. Politicians across the spectrum voiced dismay that emergency executive powers had completely sidelined Parliament. Weeks later, in April 2023, during an extraordinary session, the Swiss Parliament cast a historic symbolic vote, rejecting the government's financial guarantees in order to facilitate UBS's emergency takeover of Credit Suisse.
Vous avez fâché Madame Keller-Zutter aujourd'hui?
Non, je pense que c'est les managers du Credit Suisse qui ont fâché toute la population suisse.
While it could not undo the legally binding merger, it served as a stark public reprimand. Citizens and lawmakers alike feared that in forcing the takeover, Switzerland had simply created a mega-monopolistic giant, one that was truly too big to save. So, by August of that year, UBS voluntarily terminated the government's loss protection agreements and repaid the loans in full. Furthermore, the Swiss Parliament also convened an investigative parliamentary commission, the most severe form of political inquiry in the country's history. For 18 months straight, lawmakers interrogated executives and officials from the bank behind closed doors. When the Commission released its exhaustive report on the 20th of December 2024, it served as a sweeping indictment of both the bank and its overseers. The report placed the ultimate responsibility on years of disastrous mismanagement by Credit Suisse's own leadership. It also delivered a severe critique of the Swiss regulatory framework, validating the very failures that had forced the government's hand. Lawmakers concluded that the FINMA had been fatally hesitant. Indeed, despite witnessing years of turmoil, the regulators had failed to intervene decisively. While the Commission acknowledged that Karin Keller-Sutter and the Federal Council had successfully prevented a global meltdown in those final hours, the underlying tragedy was clear. Credit Suisse's management was clearly at fault, having been entirely consumed by a greed mindset. The regulators had simply watched this crisis build until the only remaining option was to hand the institution over to UBS.
Elle était née en juillet 1856. La banque Credit Suisse a officiellement cessé d'exister aujourd'hui. Sa reprise par le géant UBS est désormais finalisée. C'est une page de l'histoire suisse qui se tourne. On va voir concrètement quels seront les éventuels changements.
In 1856, Alfred Escher founded the bank with a noble purpose: to fund the railway network that would connect the Swiss Alps to the modern world. For over a century, it stood as a towering symbol of Swiss reliability and stability. But the institution that fell on that fateful Sunday night had long since abandoned the vision of its founder. The collapse of Credit Suisse was not caused solely by a series of scandals or a sudden market panic. It was a cultural management tragedy written over 3 decades. A slow, quiet unravelling of an institution that forgot who it was, trying to become something it was never meant to be, and ultimately discovering that a bank without trust is nothing at all. Hello everyone, thank you for watching the video and for your patience and support. Please consider subscribing and sharing the video, and as always, see you in the next one.